Hello, this is Josh Belk with the Belk on Business podcast. On today's podcast, we're going to talk a little bit about stock and debt basis. We're going to talk about a little bit about limitation on losses. So if you have a loss in your company, why you may not be able to take the losses inside of your company. And then potential additional tax exposure if you happen to own a company and you take distributions out of the company. Now, most of what we're going to talk about today is going to be applicable more toward an entity taxed as an S Corp. So if you have a corporation that's taxed as an S Corp, an LLC taxed as an S Corp, this particular podcast is going to be applicable to you. If you own a partnership, if you have a membership interest in an LLC or a partnership, then some of these rules will also apply. I think right off the bat, making some introductory comments as it relates to the basis, the equity section of the balance sheet. Some of these, kind of an area that's maybe a little bit more obscure than the other sections of the financial statement. I think may bring a little bit of clarity, try to bring a little bit of help to you in regards to what does that section mean and how does it impact your tax situation. So there are a number of ways that a company or an individual can look at a company's balance sheet and determine the health of a business. And I've gone through and I've recorded a number of podcasts on talking about the health of a company, the financial health of a company, which you can always go back and listen. But so there are a number of ways you can look at the balance sheet and try to determine the health of the company, and also it can be very representative of the financial discipline of the owner. So we many times, I know I sit in many meetings with someone who owns a business and they're looking to sell the business, and always kind of going through and telling the story of that particular business and why it may or may not be worth a certain amount. There are certain components to it. And one big component of that is, number one, the actual financial health of the company, and number two, the financial discipline of the owner. So if the owners lack some financial disciplines that relates to handling the company's cash, okay, that's directly going to impact the financial health of the company, and also going to create some tax implications for the shareholder and also the potential purchaser. So one way in order to look and see whether a company is at all financially healthy is to look at the shareholder's basis inside of the company. And so the shareholder's basis and also shareholder debt. And so looking at those two areas. And so in these areas are areas that need to be looked at when a company owner is looking to pull distributions out of the company. So it's very important to understand this particular area of the financial statements, number one, as it relates to the financial health of the company, and number two, as it relates to potential additional tax exposure due to distribution that you take out of the company. We go through in our firm, we prepare, somewhere right around 1,000 returns a year, I think, as of right now. I don't do a real good job of tracking the exact number, but I think we're somewhere right around that particular number. And I have this conversation, I would say probably 2 to 3 times a week with a company owner or my right-hand person at the firm here that handles tax preparation for our companies and the shareholders. And so having this conversation of, okay, we're going through and we did this tax planning. However, you end up getting blindsided due to not understanding the impact of your basis inside of the company. So I'm going to go through and try to define a little bit of what basis is. So one comment first before we jump into this. So most small business owners have a tendency to run their business checkbook like they run their personal checkbook. So they're going through and they're just simply writing checks, they're paying bills, not very disciplined with the process. And I'm not huge on process, but I think it's kind of one of those things that's very necessary. It's just something that I'm not all that interested in. Okay, but I know it's essential if my business is going to be successful. It's going to be essential if your business is going to be successful to have those processes in place and following them, including your process on how you go about handling your finances. So if you're going through and you're paying personal bills out of your checkbook, you're going to create and could create a potential additional tax exposure because those payments are considered distributions. They're not a business expense. Okay. And so if you're pulling money out of the company, paying personal bills, and you're not planning and properly handling those, you could end up getting blindsided with an additional tax exposure. And I'll explain that a little bit more in in a few minutes here. So not only does it create financial issues for the company by doing this, tax issues for you individually, but also it creates asset protection issues. And we we've talked about this in previous podcasts as well. So why I cannot stress enough, and I don't care the size of the company that you own, make sure that those financial disciplines are in place, that you have a method, you have a process, and you understand what's going on with the cash flow inside of your business, and also how it impacts you as the individual, as an owner of the business. So your basis in an entity, what is that? So you may have heard that term. Basis, sometimes, you know, how much skin do you have in the game, so to speak? How much, so it's basically what is your position inside of that, inside of the company? So if you go through and you start a company and you go through and you issue shares, but you didn't purchase them, you have no basis in the company. If you go through and you should be purchasing the shares, there should be a shareholder purchase agreement when you go through and you set up your entity. Okay, so you set up the company, you set up the corporation, you're actually, as the owner, purchasing those shares. So say, for example, you purchase 1,000 shares with a $1 par value per share. So you go through, you write a check to the company for $1,000 purchasing those shares. That is the proper process as it relates to purchasing those shares. And so going through and either contributing cash or capital. That is your initial basis. So I'm going through and I'm taking $1,000 in either cash or property, contributing it to the business. Now, I say property. It could be contribution of assets that you may own into the company. It could be furniture, equipment, whatever the case may be, that has a value, a basis to you of that amount. Most people don't do it. Most people go through and just purchase those particular shares. So any sort of cash or property contributes to the business, that becomes your basis. So that either becomes your starting basis, or going forward, if you put more cash or property into the business, that would increase your basis. Okay, so that's the first step. So what is the cash that has been contributed? What is the property that's contributed to the business? The next step is to either increase, so your base is either increased by your net income. Now this is your net taxable income, or you're decreased by your losses. So if you're going through and say you utilize bonus depreciation, however, you're utilizing bonus depreciation, section 179, whatever the case may be, but you did not fully purchase that asset and you also have a loan on the books, it can create a situation to where that bonus depreciation creates excess losses that you may not be able to recognize when it comes to filing your tax return. So first of all, your cash that you've contributed, property that you've contributed, you add to that the net income or decrease it, subtract if you have a net loss, and then it is also reduced by any sort of distributions. So you can kind of visualize a little bit that particular calculation in your head. So cash you put into the business, cash you've taken out of the business decreases it, net income increases your tax basis, a loss decreases your basis, your shareholder basis, your stock basis in that entity. Another thing I want to point out here as it relates to stock basis, and there are two types of basis. I'm going to get to the other one here in just a second. So the first is stock basis. And one thing I get told on occasion when they go through and they want purchase agreements drafted or whatever the case may be is, well, this is being purchased with sweat equity. Okay, I want to point out here, there is no such thing as sweat equity when it comes to tax or to GAAP essentially either. Okay, but there is no such thing as sweat equity. Now, if someone earns those shares, okay, you need to pay them. That is called compensation. That's not sweat equity. Okay, so if someone's coming through and they put a bunch of time and effort into the company, you're going to want to quote unquote gift them or give them the shares. They're going to have no basis if that's the way you go about simply giving them the shares. They're going to have zero basis. So if you're a shareholder and that's the way you obtained your shares, you have no equity, no basis, no starting basis in the entity. So if you're wanting to compensate that individual, you need to pay them. Okay, so either pay them either as an employee or as a contractor. Then they turn around and they purchase the shares. That's how they would obtain some initial basis, stock basis in the entity. Okay. Now the other type of basis is debt basis. And debt basis is a little bit more confusing. I want to point out here when it comes to the stock basis and debt basis, this is not at all inclusive of everything. I'm not going to talk about tax credits and these other types of areas that have an impact on your basis. Okay, that's something I think is too broad for this particular podcast. But if you have those situations, we do have clients with special types of credits, things of that nature. Make sure you're working with your tax professional so you understand how that impacts your basis before you get to the point of wanting to take distributions out of the company. Debt basis. So debt basis consists primarily either of loans by the shareholder or payments on company loans by the shareholder. So if the shareholder goes through and they, so say for example, in my particular company, I go through and I contribute, I make a $100,000 loan to my company. At that point, I have a debt basis. However, that loan has to be bona fide. It has to be a bona fide loan, and I'll explain the components of that here in just a moment. Or if the company has a loan, and I go through and I make those payments. Okay, so if I went through and I made those payments on behalf of the company. Okay, so the company is the company has the loan. They weren't able to make the payments. I, as a shareholder, go through and directly make those payments. Then at that point, I would have additional debt basis inside of the company. So that doesn't happen too often. Usually, when that situation happens, usually there's some journal entries that are done, and so it ends up rolling into the stock basis. The other one is the debt basis that relates to loans. Most of the time, when working with our clients, until we start working our way through this process with them, they do not do this correctly. So either they say, okay, well, I'm just going to consider this a loan, or they don't have all the components that are required of that loan. So what are those components? So for a loan to be considered a bona fide loan, amongst other things, it must include the following. First of all, expectation of payment. So if I go through in this $100,000 loan that I'm going to make with Lodestar, my company that I own, my Lodestar Tax and Consulting, if I'm going to go through and I'm going to make this loan to the company, if I go through and I even if I draft all the paperwork correctly, but I'm like, you know what, I'll just pay myself at the point that the money is there and I can pay myself. That is not a bona fide loan. Okay. So first of all, there has to be an expectation of payment. So think about this as we walk through this. If you were a third party, if you were a bank, if you were even a private lender loaning money to your business, are you going to check mark all those boxes that they normally would check off? Okay. So first of all, there has to be an expectation of payment. Secondly, there must be loan terms. So there has to be a loan amount. There has to be a payment amount listed, an interest rate, and a maturity date. Okay, you just can't have an open-ended, I'm going to, 100,000 when it pays me back, and maybe I'll calculate interest at that point. That is not a bona fide loan. Okay, so there must be loan terms. You have the loan amount, payment amount, interest rate, maturity date. There also needs to be inside of the loan document remedies for default. So if I, as the shareholder, go through and I just lent $100,000 to my company, and in that particular promissory note or loan document, I don't have any sort of remedies for default. Okay, that is another area to where the loan document can be looked at and say this is not a bona fide loan. Next, the loan must truly be intended to be a loan. Once again, I go through and I have this loan for $100,000, but I'm not taking it seriously. Okay, I'm kind of like, well, I'm just going to do it here so that way I can simply, go through and create this debt basis. Then I truly don't have a loan. It needs to truly be intended to be a loan. Another item needs to be in there is some sort of a subordination clause. Where does that particular shareholder fall in line as it relates to other general creditors? Okay, and then lastly, the last piece that must be there is in some sort of an enforcement term. So I, as the shareholder of my company, lend $100,000. There needs to be some sort of remedy for default, and then what is the enforcement action that are going to be taken? And so we're going to go through. Is it going to be arbitration? What is that language? What does that language consist of? Anytime, and all of us probably at some point in our life have gone and gotten a loan inside of our business. Look at that loan document. What are those components that are there? Work with the attorney. Make sure all those components are there, and that you do actually follow the terms of the loan document. You don't go through and say, okay, well, I'm just not going to pay myself my interest or my principal payment this month because I don't have the cash. Okay, would a third-party lender allow for the same thing? Okay, well, maybe they'll give you 30 days or whatever the case may be, but once again, those terms, those remedies must be inside of that loan document, that promissory note, and it must be followed. Now, why is this all important? Okay, so when you go through and you're in a situation to where you look at your stock and your debt basis, and you combine those, and you look and you say, okay, at the bottom line, if my basis is negative and I have a loss inside the company, my losses may be limited, or I may not be able to take those losses at all. We have seen situations to where clients have their company lost $100,000 during the course of the year, but they took $50,000 in distributions, and they did not have the basis to recognize the losses, and they took $50,000 in distributions, and they run into a situation where they can't take the $100,000 in losses as a loss on their tax return, and they end up paying tax on $50,000 that the company didn't even make. Okay, so number one, why is it important? Can I recognize my losses? Okay, if I don't have the stock basis or the debt basis, my losses may be limited or may be disallowed altogether. We run into the situation on occasion with clients to where they think, okay, my company ran my P&L inside my QuickBooks, and I see my company lost $150,000 this year. It's going to offset my other income. I'm good to go. Okay, but failing to realize that they've drained their company with cash, they've made some bad decisions that relate to the financial health of the company, and they don't have the basis to be able to recognize those losses. Secondly, distributions. If you take distributions in excess of your basis inside of your company, so you go through the money you put into the company, the losses you've recognized, everything else, and then I look at the rest of that number, and if that number is zero, that number is negative $10,000, whatever it is, and I decide to go ahead and take money out of the company, I'm going to get taxed on those distributions. Now, normally an S corporation is a pass-through or flow-through entity. So you pay tax on the personal level basically on your portion of the net income or the net loss of the company. So if the company made $100,000, you're the sole shareholder, you're going to recognize that $100,000 as income on your tax return. If the company shows a loss of $50,000, you're going to recognize that loss on your individual tax return. But you can run into a situation to where if you don't have the stock basis or the debt basis to be able to recognize a loss, once again, you're not going to be able to recognize the loss, or it may be limited to whatever basis you have in the company. And then if you decide to take distributions in excess of your net income of the company and your basis of your basis in the company, then you can end up in a situation to where you're paying tax on money that you took out of the company, even though your company lost money in a particular given tax year. This is Josh Belk with the Belk on Business podcast. Hopefully this brought a little bit of clarity and understanding as it relates to your basis inside of the company and the tax implications, whether your company is making money, is losing money, and then also how distributions are taxed at the shareholder level. This is Josh Belk with the Belk on Business podcast. Have a wonderful day.